Hey, what's up? Welcome to day 35 of Trying to Become a Great Investor. This is VFC, VF Corporation Analysis Part 3. So, in the first two parts, I was able to kind of start out with my thesis of why I currently think VF Corporation is undervalued and some of the catalysts behind that. I think just to give a quick review, there's really 5 different reasons why I think VF Corporation is... Actually, you know what? I'll start this off by saying, what is VF Corp? And... yeah, how should I start this up? So, what is VF... oh my god. God damn. My throat's dry. Alright, so maybe I'll start off with... what is VF Corp? Why people should invest, and what progress I made so far. Okay, maybe what's this for? So I am trying to learn how to invest a little bit, and recently I've found out about this company called VF Corporation. And this company is a holding company for a bunch of smaller brands, clothing or footwear brands. Some of the biggest ones you've probably heard of are The North Face, Vans, Supreme, Timberland, Dickies. Those are just the 5 biggest brands that VF Corporation owns today. And this is something that I think is really relevant to what I'm interested in. I'm really into fashion. I like buying clothes and buying shoes. But I've kind of now wanted to focus on buying stocks instead of all these clothing and apparel items. And so I thought, okay, might as well learn through investing in some companies that I might be interested in. Okay, that was a long-winded way to saying why I chose this company specifically, but recently I saw that the stock price is at honestly like a 10-year low, 10-year record low. It's trading at a market cap of around $6 billion. And I think it's really interesting because there was a 70 or 80% decline in the stock price in the past year, or maybe 2 years. So let's see. Yeah, these are all things I should probably have memorized. VFC stock, 5 years. Yeah, in the past 2 years. Yeah, okay, so let's see. Okay, I'm back from blowing my nose. What? Yeah, so let's take a look at the price here in 2022. So that was about 2 years ago. Price was at 72, and then about a year ago it's at 30. Okay, so that's pretty much when Steve Rendell left. So it's been about a year since Steve Rendell left, and now we're at this point where the company is geared to turn around. We're not too sure if that's going to happen yet, but I think that the company is poised to turn around. And so I think the 5 different catalysts that I have, the main one is that the North Face and the outdoor segment of VF Corporation is doing really well. So they're having consistent growth rates in past quarters. And I think ever since the pandemic started and after the pandemic recovery. I have to double check a little bit on that. I have to reaffirm, but I think that's like the basic idea of. That's one of the foundations of my thesis. Man, I'm not doing too great here. So the second one I have, maybe I could go. Let's see. Let's see if we can. Quarto render preview cd preview vfc.qmd. Okay, so here is so yeah, here's what I have so far. All right, we just talked about VF Corporation and some of the current struggles. Actually, I haven't touched on that. So let's just go through this. I think this is a better framework of where I need to start and kind of gather my thoughts. So VF Corporation is a holding company for a lot of major brands within the apparel, footwear, and accessories department. So some of the major brands are Vans, The North Face, Supreme, Dickies, and Timberland. And right now, the VF Corporation is facing a lower growth within its Vans business segment, combined with higher growth in operating and financing expenses. So this is causing overall margins to deteriorate, and the company is facing elevated debt levels compared to historic levels and among its peers. So those are kind of the big risks involved right now and why the stock price has declined so much in the past 2 years. And so I think despite this, VF Corporation is well positioned to turn around its business, and I really do think it's being undervalued by the market. And this really is based on 5 different catalysts. So the first one is that the North Face and the outdoor segment of VF Corporation, there's 3 different segments: the active, the outdoor, and the work segment. The outdoor segment is really growing at a really strong rates, especially the North Face brand. So I guess it's fueling the growth. North Face is fueling the growth for the outdoor segment. And the second is that Bracken Darrell is the new CEO. He was recently hired about 6 months ago, and he's really trying to push a new business strategy called Reinvent that restructures the business so that these brands are more autonomous. They don't have to really report directly to a corporate Death Star type model that Steve Rendell incorporated into the business. And he really wants to cut costs and reduce debt. Number three, the acquisition of Supreme in 2020 has proved costly to the business, but international operations, they really do look promising in the future. So I think what this really highlights is the international presence of VF Corporation and specifically Supreme in Asia. So Supreme recently opened a store in Seoul, Korea, and it's been performing really well. So I think there's a really interesting opportunity there. And then 4, activist investor Engaged Capital built a substantial stake within VF Corporation, and it believes that the company can turn around. It will help the company focus on reducing costs, operating more efficiently, and achieving a stock price of, it's predicted, around $40. And then the 5th is, in order to kind of restructure its portfolio, VF Corporation is selling off its PAX business. It seems like it's in the process of doing so, and I think through that it's able to increase some of its cash flow. temporary short-term cash flow and help reduce the leverage on the balance sheet. Okay, so then I've split this up into 3 different sections. So understanding the past, forecasting the future, and then valuations. So when I'm looking at this here, I've tried to build this so that I'm looking at, okay, how did VF Corporation get to the point where they've had a 70% decline in their stock price within the past 2 years? What has their strategy been like in the past, and what is it at now? And forecasting the future maybe is a good point to talk about what this reinvent strategy means for VF Corporation, forecasting the cash flows in the future, and maybe forecasting the income, balance sheets, and also the cash flow statement. And then finally, in the valuation section, this is where we can conduct our discounted cash flows and relative valuation analysis. And so this is the section I want to focus on, trying to estimate the stock price of VF Corporation based on its intrinsic value, which is just the future cash flows. And then also figure out how VF Corporation is valued in terms of its multiples compared to the rest of the market. The rest of the market being companies within its specific industry, so the apparel, footwear, and accessories industry, and also maybe companies outside of the industry that are also facing turnarounds. So that's the broad highlight of what the sections are focusing on. Yeah, I have like a little snot coming out. Okay, and so when we look at when we try to understand the past and take a look at the business strategy of VF Corporation, we can see that it's really been the leader in the apparel, footwear, and accessories market for the past 100 years, and it's really been able to stay at the top by just acquiring, divesting, and spinning off different brands, so restructuring its portfolio of brands whenever they think that there's a good opportunity to either acquire a business, to sell off a business, or to completely spin off a collection of businesses. So from the 1970s to the 1990s, this is when VF Corporation was one of the largest apparel manufacturers and retailers in the world. So this is a time where the fashion scene in the fashion industry, jeans were pretty much one of the biggest trends at the time, and VF Corporation was the biggest jeans producer with its brands like Lee and Wrangler. So those were its 2 most valuable brands of the 1970s and 1990s. They brought in, I think at the end of 2000, about $3 billion in revenue, okay? Then when the 2000s came, in the 2000s, in the 1990s and the 2000s, there was a shift towards more athletic and athleisure type of apparel and footwear. And this was really pioneered by brands like Nike, Adidas, New Balance, Champion, and Russell Athletics. These guys were the creators of the hoodies, the sweatpants, and this really moved its way from more athletic university football to professional sports teams to kind of mainstream fashion or mainstream apparel. And these companies really took off in the 2000s, in the 1990s, 2000s, and 2010s. And during this time, VF Corporation was pretty active in acquiring and divesting businesses. So in the 2000s, this is when VF Corporation made its 2 biggest acquisitions to date, or not in terms of dollar amounts, but the most valuable acquisitions, I would say. So the first one is going to be the North Face, and the second is Vans. So the North Face was acquired in 2000 for about $155 million, which is a pretty cheap price at the time. The company was struggling a bit. I think there was some scandal going on with the management, But then Vans was also acquired by VF Corporation in 2004 for about 400 million. And so this really placed VF Corporation in the position to capitalize on the new trends within the apparel footwear market due to all of this new boom in the athletic and athleisure apparel. And these brands really did help fuel the growth of the business, VF Corporation, for the next decade. And so when you reach the 2010s, we see that VF Corporation has grown a lot and has a lot of cash and potential for future cash flows. So they decided to make a few more acquisitions during this decade. First one was Timberland in 2011. So this is a pretty big acquisition in terms of the actual deal value, about $2 billion in cash. And this was added to the outdoor segment. And in 2017, VF Corporation purchased Williams&Dickies, and this added a valuable brand to the workwear segment of VF Corporation. Okay, and then once we reached the 2010s, VF Corporation started to face some difficulties and growth within its active segment. So this is anchored by Vans. So this is the most valuable brand currently in the active segment of VF Corporation and one of the primary drivers of growth of VF Corporation in the past 2 decades. But once post-COVID, Vans started to deteriorate in terms of its growth. It wasn't able to maintain its steady growth rate in the past and also faced some decline in revenues. And so this is kind of where we're at today. But one thing before I kind of move on is Supreme was an acquisition made in 2020 for about $2 billion in cash as well. And this caused VF Corporation to leverage up from a 1.14 debt to equity ratio to 1.87 debt to equity in order to finance the deal. So that's also another big catalyst into why the stock price ended up kind of falling down so much. Yeah, maybe I need to talk a little bit slower. Okay. Yeah, and when we analyze the Supreme acquisition, it doesn't seem like it's been a great purchase for VF Corporation. It's had to write down the value of the acquisition and the value of intangibles in terms of the patents and trademark, more so trademark and copyright, and also had to devalue goodwill. And that combination of devaluation or impairments of intangibles and goodwill is valued around $700 million. So that was kind of a brief history of the acquisition strategy of VF Corporation. And as we look past that, we can look at some of the overall business strategy, specifically one big strategy within the tenure of Steve Rendell. He was CEO at the end of 2017. His goal was to really shift a lot of the sales and operations towards direct-to-consumer instead of wholesale or B2B. And he also really wanted to increase VF Corporation's Asia presence. And so when we analyze how this has impacted the performance of VF Corporation, well, we can see that, first of all, in fiscal 2017, about 32% of revenues came from direct-to-consumer operations. And Steve Rendell, he was able to actually bring that up to 45%. So I believe that's a 13% increase in the actual revenues from the direct-to-consumer operations. And looking at the income statement, we want to make sure that this is actually providing some value for the business itself. And we can see that gross margins have improved since fiscal 2017 by about 2% as of fiscal 2023. But with that being said, even though gross margins have increased, we also have selling general and administrative expenses that have also increased as well. And so that's kind of where I left off last time. I was able to do the calculations for gross margin, but I want to be able to see the increases in SG&A. And so maybe it'll be nice to have a graph in terms of the total economic profits or loss based on those expenses. And so I think the SG&A expense is pretty important here because this SG&A expense increases with the shift towards direct-to-consumer because VF Corporation has to open stores, physical retail stores, and hire people to actually work in those stores. So I think that's part of the general and administrative expense. And also with the maybe, what do you call it? The e-commerce infrastructure that VF Corporation has to build. It has to hire web developers. It has to hire a lot of technology experts in order to build these products, build these websites, build these platforms. And also it has to take care of its entire supply chain and maybe move towards warehousing its own product instead of having third-party suppliers or maybe other retailers that would help store the product for themselves. Okay, so I think this is a good point to kind of pick up where I left off. And so let's take a look here with, oh, shoot. Okay. So let's do years is equal to 2017, 2018, 20, you know what? I think we could do this. MP.A range. So we can go from 2017 to 2024. One list of years from 2017 to 2023. Okay. So yeah, I don't think I Okay, so what I first want to do is, what I'm trying to do here is trying to create a graph to see how the gross margin has changed over time. And maybe I can create a histogram or maybe a line graph. And so what I want to do here is probably just find the gross profits is equal to I'll keep this at 2017, keep this at 2017. Let's see something real quick. Okay. All right, that's good. And then we have revenues is equal to VF Corporation dot log revenues mask. So years So this should be gross profits 2017 to 2023. Oh. Maybe it wasn't a good idea to have such long variable names. Revenues 2017 to 2023. Okay. Alright, that's good. And then margins, gross profits divided by revenues. Okay, and then now I think we could do matplotlib, or we could use SNS. So I think in this case, let's see what. Let's just try using a simple. I think this would give us a line plot. So let's do years, gross profits, gross margins, and let's see what this gives us. Okay, it's interesting warning. None of N64 index. What does this mean? So let's see. Okay, this actually makes coding a lot better. I wonder if it's possible to share this part of my screen. Okay, wait. Let's see. Oh, there we go. Nice. Move to bottom. Okay, yeah, this is nice. I can now code on my desktop instead of looking down here. Okay, yeah, this is a lot better. Still not the best though, but it'll make do. Okay. So we print years. Let's see what happens. Right. I don't know if N64. Can I not do that? Frame lock. Wait. Test.ipy. Ports pi SMP port pandas as PD. Yeah, maybe I could just use this as whatever I use to run. So yeah. Oh, okay. Because these need to be strings, that's why. I'll just do it manually, it's fine. Okay, so 2017, 2018, 2019, 2020, 2021, 2022, 2023. Right. Is this gonna work? Oops. Still nothing. Right. So what happens if I do this? Right, and okay, so print gross profit. Right, so what? Years. Oh wait, can I do something like this? 2017 to 2023. Oh, okay. Does this go all the way to 2023? Let's see, print gross margins. What does this look like? I see. How do I do element by element? Panda series. Is this still the same? Yes. Why do series divide not work if X is different? Series that reset index. Just reset the index. True. Okay, this might help. $17. Get 0. series shape. I'm gonna delete this for now. Put this down here. I didn't realize working with these series was this annoying. So gross margins, dot shape. This. Maybe there's a better way to do this. So how to divide rows in pandas. So why does series have a shape in columns? Wait, so this might not actually, this might be a data frame. So print type. How do we get, why is this a data frame? Print revenues. See. Lock 0 maybe. Okay, yeah. So as best plotting library for Python. Matplotlib, think maybe Seaborn. Histogram bar plots. Group bar chart. that's interesting. So we have revenue mask. And maybe we could create a function. So def gets data, and we pass in, let's call this an account name, string, and then we also pass in data frame pd dot data frame. Okay. So what we'll do here is mask is equal to frame account name account is equal to account name frame dot lock name mask, and then let's do here's one, here's one. So let's start in here. Drop is equal to true. So this is profits. Total revenues. Okay. So years. VF annual income statement. Oops. Turn. Profits. Oh, nice. makes it easier for us. So we have gross margin. I think what we could do here is just divide by revenues. Okay. Alright, so this makes it a lot easier. Alright, and then we want to do selling general administrative expense, right? G A is equal to get data so years VF statement as reported GA revenue ratio is equal to G&A divided by revenues. Okay, nice. Alright, so there's plots data is equal to gross margin we have gross margins G&A G&A revenue G&A G&A revenue ratio. Okay. Width is equal to 0.25 multiplier to 0. Label locations. Okay. PLT.show. So x is equal to length. Let's take a look actually, let's see what's going on here. a range. Let's see. It still only says so we print attributes. Just do anything. Oh, nice. I get a message. Okay. Okay. I think this might be. Except for label Rex. See. Does this work? Oh, just let's do anything 0.5. Maybe 0.3, 0.5. Penguin attribute by species. So S, G, and A. for VFC and depreciate. So this is SG&A and gross margins. Oh yeah, how to round elements in data frame. Round. Let's see. So dot round doesn't seem to do anything. Oh, yeah, so this doesn't matter. I think this matters, yeah. 0.55. Okay. Start legend. For left. Gallery. Line plot, plot. Byline plot. Pair plot. Oh, maybe this is where ChatGPT could help actually. So. How do I change color? grouped bar plots. Oh, interesting. Okay, so I also want to find the change. And let's say change in gross profits, change in SG&A equal to I think this is gross profits minus gross profit shift. Print gross profits. Change gross profit. Oh, also it has to do with the revenue effect though, right? Yeah. I'm not too sure how to do this because I feel like, so the problem I have here is the change in gross profit may not actually reflect the benefits of the direct-to-consumer strategy because it could be the effects of revenue. So as revenue increases, then gross profit might increase as well. Right? Yeah. More revenue, more gross profit, less revenue, less gross profit. So I feel like this might not be the best way. I think the gross profit as a percentage of revenue, though, as a share of revenue, that's probably the best way to look at it. Okay. It's 1:39. Probably need to go to sleep soon. Interesting. Random list of funds. Interesting. Okay. So maybe I look at 0.55. Divided by 0.38. And my mind's starting to get fried. Probably gonna spend another 4 more minutes in this, and then it's good for me. Okay. Maybe I'll leave this analysis here for now and come back to it. So what's some takeaways here? We can see that gross margin as a percentage of revenue has increased, but so has the selling, general, and administrative revenue. Yeah, I wonder what the dollar amount is with gross. Okay. Oh, maybe we could capture the spread, right? Spread minus fig size $14.8 layout to constrained subplots fig. Point 1.25 GNA. Okay, so the spread between the two have increased since. Oh, no columns. I see, this is where this comes into play. Okay, so I guess the spread has decreased from 0.13 to 0.1. So I guess that's good, actually. The spread is measuring the difference between the gross margin and the SG&A to revenue. So yeah, I guess that it was a somewhat successful campaign to go direct to consumer. The company has been able to reduce its selling general administrative expenses, so that's nice. Okay. I think that's the main takeaway for today. So let me add this here. Specifically SG&A. VFC has to pay for new employees to work in stores and build a supply chain that supports DC operations. Looking at the spread between the gross margin and SG&A to sales shows that there was a reduction spread past the past 5 years, in the past 6 years. Years. Indicating that the shift from direct to consumer might have had some benefits to the firm, to VF. Wait, so I think I'll leave it at that for now. One thing I do want to check though is, so VF Corporation switched their fiscal period, fiscal reporting from January to March in 2018. And I want to make sure that, I want to see whether or not our values that we're using are adjusted for that shift or if they're not adjusted. So for 10K VFC, I think what I'm going to do is I'm going to take a look at the 10K for VF Corporation in 2019. Is this the one? Yeah, okay, so 2019. Okay. So it doesn't seem like it's adjusted. Damn, okay. So I might need to make an adjustment within, yeah, I might actually need to make an adjustment with the data itself. Shoot. Okay. All right, I'll save that problem for tomorrow then. And then I think I also want to maybe work on forecasting the future a little bit. Actually, look at the growth for North Face. Yeah, so it seems like the segment change for outdoor has been pretty strong. Okay, so let's take a look. So look at the performance of each business segment and the performance of VFC's main brands. Okay, I think that's what I'll save for tomorrow and then use that information to help build my forecast. For now, I'm happy with, although this did take a while, but just being able to build a way to see how some business strategy, the shift from direct to consumer, from B2B to direct to consumer, has impacted VF Corporation. And it seems like, judging from this pretty quick and easy group bar chart, we can see that gross margin has increased since 2017. And also the SG&A to revenue ratio has also increased. But the spread, or the difference between the two, has decreased. Oh, I'm misinterpreting it, because we would want this spread to increase. That means that the company, VF Corporation, is earning more, or is earning a higher percentage of operating margin compared to the selling general and administrative expense. So this is actually bad for VF Corporation. Made things up. I've made operations less efficient. Yeah, okay. So, yeah, that shows that. Okay, so that is a great thing. That's the spread is kind of getting tighter, and so that's not good for VF. Alright. Alright, I'll save that for now. In that case, see ya in the next